Welcome to our monthly economic update. We all acknowledge that the one constant in markets is volatility, and we all accept that heightened volatility is always but a moment away. Volatility can be triggered by any number of things. Consider the events which have accelerated volatility in markets over the last 4 years: a global pandemic, a war in Ukraine, a regional banking crisis in the US, and simmering tensions in the Middle East. In this time, there's been a lot for markets to digest. Now, for investors, this makes constructing investment portfolios particularly challenging. How do we stay well prepared for the annual cycle of once-in-a-generation events? Before we consider that further, let's pause and reflect on where we're at on the sliding scale of volatility. With economic data in such keen focus, Australians have all got a view on the key economic indicators, particularly inflation, but also unemployment, economic growth, and of course, central bank rates and property prices. These key economic indicators each point to a period of normalisation, a case for measured optimism. Unemployment is low and staying low. At 3.8% in March 2024, even a sharp uplift would still have Australia in a position of full employment. Inflation is moderated. There is, of course, a risk that it stays sticky, just like the experience across in the US. However, there is no doubt that the hard work done to date has been effective. Economic growth is also positive, albeit soft. But after a pandemic and a sharp uplift in interest rates, the fact that it's positive remains a good news story, and certainly a better story than the recessionary environment the UK is experiencing. And hence the case for measured optimism. But it is measured because the next round of heightened volatility could be just a moment away. As part of a National Financial Advisor roadshow through March, we were asked to present our views on the headwinds and tailwinds which will likely drive our economic fortunes in the year ahead. The wildcard for 2024 we presented was geopolitics. Geopolitical risk represents the outcomes of interactions between countries and how they impact on things like trade relationships, security partnerships, supply chains, and territorial disputes. And you only need to consider the war in Ukraine and the impact it had on global inflation and interest rates to get a sense of how geopolitical risks can really drive negative market outcomes at a moment's notice. We're in a period of heightened geopolitical risk. The war in Ukraine is now into its third year, with no resolution in sight. There's a war in the Middle East, which, given the recent involvement by Iran, continues to escalate and further draw in both neighbouring and politically aligned countries. These are just two global conflicts which could escalate, de-escalate, or otherwise drive economic outcomes here in Australia and across the globe in 2024 and beyond. Our caution is always to remember that volatility is perpetual. You never know what's around the corner. For investors, preparation begins with clear-minded asset selection. While it might sound daunting, there's a wealth of external resource you can consult to get some helpful guidance on broader asset class thematics. For example, Morningstar have recently called bonds as being too expensive relative to prevailing inflation. Similarly, it's no secret that domestic equities are enjoying a strong bull run, with the largest 200 firms on the Australian Stock Exchange currently near an all-time high. It's great for investors today, but hardly a scenario to offer an investor protection from future volatility. A big shift by asset allocators currently is fixed income investment to control volatility, in particular private credit. JP Morgan have included private credit as one of their high conviction investment ideas, particularly direct lending, citing that it's not a new asset class, its growth is not excessive, forward returns are strong, and the market is offering investors adequate compensation for the risks. Trobe Financial's new wholesale offering, Trobe US Private Credit Trust, seeks to provide Australian investors with an opportunity in this asset class and the thematic as described there by JP Morgan. What's more, our existing range of portfolio accounts from our foundation asset class of Australian property credit each continue to demonstrate zero capital losses since their inception date, with particularly low volatility income returns throughout. Timing markets at the best of times is difficult. Timing investments around risks is even more so. In a volatile world, building a well-diversified portfolio with a view to cross-cyclical performance can make a real difference to investment outcomes. Thank you for watching.